Hi, welcome back to the Pickers channel. Today we're going to talk about timing the market. So, sounds easy, huh? So, let's take the time and talk about the quick pros and cons about timing the market. That way you can have a good, well-rounded understanding before you jump in. So, today we're going to talk timing the market and how you can benefit from it if you know what you are doing. So, you have to ask yourself, what does it mean to time the market? Now, timing the market means basically you buying investments in a prediction mode to determine if the market is going to move north or south. So once again, timing the market, understanding the predictions of how your investments will work for you. Now, basically, investors try to buy at the lowest point and sell at the highest point. Now, let's start with the benefits. If you are successful with timing the market, the rewards could be huge for you. Pro number one would be maximize gains. If you perfectly time the market, you can maximize gains quickly by buying low and selling high at the market's most highest peak. Pro number two would be avoiding losses. Timing the market can help you avoid losses in the downturn by selling at your highest point before the market price drops. Now, we talked about two pros. Now it's time to get into the cons of timing the market. Now we have to address the downside, and there are quite a few downside cons that I want to share with you. Con number one, it is extremely hard to time the market. Even professional investors struggle to predict market movements. The market is influenced by a lot of factors. So basically, trying to time it is very rare that you are successful at doing it. Con number two, you miss out on long-term gains. By jumping in and out of the market, you might miss rewards of big upward trends. History has shown us that markets tend to rise over time. So the best practice would be to stay invested over the long term. Finally, con number three, emotional stress. This gets people every time. So basically, if you're constantly monitoring the market, you're dealing with volatility and you're wondering, is it a good time to buy or a good time to sell? All this adds to emotional stress and could allow you to miss those upward trends, because if you sell, you will sell at a loss. So basically, we just addressed three cons. Hard to predict, you'll miss long-term gains, and emotional stress. If market volatility seems too risky for you, there are other alternatives that you can leverage in regards to you investing into the market. There's this term that I shared in a past video called DCA, dollar cost averaging. You should possibly look at that because you investing your money over long term yields you that growth, success, and maybe some market stability over time. Ultimately, stay invested over the long term and understand dollar cost averaging and deploy these two key features for you. And over the long term, you will start to see financial success and compounding interest and growth. So finally, if you should try to time the market, it could be risky. I get it, it is tempting, but the risk will outweigh the reward. Thanks for watching. If you found this video helpful, give us a thumbs up and like and subscribe. Most importantly, do your research and do your best to try to understand the market. There are so many different financial platforms out there that can assist you in understanding market analysis. Lastly, stay invested over the long term. Remain disciplined and remain consistent. Until next time.